Ryan said, we're going to try to cover a number of things. And as I usually do with you guys, I really enjoy when you ask questions as I go through the presentation and we have a dialogue. We can talk. Because for me, just to talk is not that fun for me. I really enjoy it when I get the chance to interact with you guys. So feel free to just ask me questions as we go along, and we all learn from each other. So the Eurozone, you guys probably hear enough about this. You're well aware of what's going on. And the only thing I want to point out here is that the problem with Europe is somewhat unique to Europe in the sense that they never really finished the Euro monetary union, because all they did was go with monetary union. They just created one currency, but they never went to fiscal policy. And if you take a look at what the U.S. did, and any other country, quite frankly, that has truly a sovereign fiscal capability, and you compare it to Europe, you can see what's going on in Europe. In the U.S., you have to have monetary policy, which is low interest rates. On the European side, they had the ECB to do that. They were making policy mistakes. Until recently, they were raising interest rates, believe it or not. Now they just finally cut it. But the piece that's really different is the fiscal side, where in the U.S. and other countries, you have what the U.S. is called the Federal Reserve and Congress. They can also do things in terms of raising public cash, either creating it, literally printing it, or raising it in the capital markets, and using that to do various things to guarantee deposits, put capital infusions in place, do the things you need to do to stop the crisis. And what's happening in Europe is they simply don't have those mechanisms. They've never really created a union. All they did is share a currency. And what you're finding now is the capital markets, this has all been exposed, and the capital markets are simply adjusting to the fact that even though Italy, Spain, and France, and Germany are supposed to be all under one economic union, European Union, they really are independent sovereign nations. They have to act independently. There's no ability, and the caveat is, the interesting piece is, they have to act independently because there's no European mechanism to do it for them. They can't do euro bonds, they can't print euro dollars. They literally can't print their own currency. So what happens is the capital markets have taken over. They are now in control. Capital markets are readjusting, and to the fact that each of those sovereigns are on their own, and that's why you see these interest rates and all this chaos that's going on over there. Point to make here, this is a European policy problem. This is the way I look at it. This doesn't necessarily have to translate into contagion. It's not a problem where it's necessarily going to spill over for the same reasons as other markets. It's a policy issue. Europe has to decide what it wants to do. I believe that the resistance to doing the things they want to do is really trying to force certain countries out so that the end countries that are remain members of the European Union are the countries that ultimately can create fiscal unity, because they trust each other a lot more than the southern European countries. So that's what's creating all this volatility, that's creating all this uncertainty, making everyone nervous. So we're all climbing a wall of worry, and as advisors here, you know that sometimes that can create some opportunities. If you take a look at the U.S., and I'm trying to really focus this now onto the U.S., all this volatility, how to really look at it. In the U.S., it is very gloomy, both in terms of business confidence and consumer confidence. In fact, the consumer confidence number is one of the lowest we've ever seen. Now, that represents how people feel. But when you take a look, as I did in the past, and look at the facts, what they're actually doing, you're going to see a different story. Now, one of the other things I just wanted to point out here is Europe, as it relates to the U.S., represents 22% of its exports. But because the U.S. itself is a consumer country, consumes what it produces internally, it really only represents less than 2% of the U.S. GDP. Everything the U.S. corporations send to Europe, less than 2% of GDP, something like 1.6%. It's really not that big of a deal, what's going on there. And the real implication for the United States, in terms of its growth rates, is what happens in the rest of the world. In other words, how does Latin America, how do you guys and China and the rest of Asia, how are you guys going to react to what's going on in Asia? In Europe. That's what's going to be important for what impacts the U.S., not what's going on in Europe by itself. So all the austerity issues, all the concerns, in isolation, that won't have much impact on terms of the U.S. because the U.S. has diversified well beyond Europe, really focusing more here in Latin America, two primary growth markets in the world. So with that in mind, there's a couple other things we need to look at. Clearly, there's European funding stress, intra-bank and otherwise, but if you take a look at it from the dollar terms, which is what LIBOR is, it's dollar funding, the stress has increased, but it's not that big of a deal. It did go up from 19 to 48. That does concern me a little bit, but In January 2008, before all the crisis began, it was around 0.75. So if you think normal is 0.75 spreads, the 10 spread's 3-month euro dollars, 3-month treasuries, we're still nowhere even close to normal. And this really represents the amount of money, the U.S. dollars that were created and injected into the system. It's not creating financial funding concerns for U.S. corporations. And if you take a look at from a currency point of view in dollar terms, the euro has weakened a little bit from the peaks, but you can see here, it really is still pretty well contained within a range. So we're not seeing the euro devaluation risk coming into play as it would relate and impact the U.S. earnings, corporate earnings. So I guess what I'm trying to say here is Europe, with all the noise, the concerns and fears that are out there, as it translates into economic impact to the U.S., it really hasn't made a difference yet. It hasn't really impacted the U.S. Not in terms of stock prices, clearly, that's a separate issue, but in terms of the underlying fundamentals of the country. And then I'll show you some more of what I mean by that as we go forward. Where there has been a big impact has been in commodity prices. You can see here that commodity prices have come down dramatically year to date across the board. This may have been more to do with the policy-driven slowdown in China than it had to do with Europe, so it's very hard to tell what Europe is actually doing in all of this. But oil remains up for the year. And so from a sector point of view, as you start looking at opportunities, energy remains a sector that could have opportunities. I've seen some pretty good research coming out of here for Asian firms that are in the energy sector, which are bullish, and that also translates, I think, into bullish opportunities in the U.S. market and the energy sector. So while I can't necessarily talk about individual stocks, I would suggest continued focus in terms of the energy sector for opportunities both in your own markets, but also in the U.S. markets. Okay, so the point there is, even though commodity prices are coming down, we don't see deflation, I should say. We're still seeing inflation in both the U.S. and in Europe. That's an indication that you still have end demand. Still, it may wane. Maybe austerity will impact that end demand, but we're certainly not seeing it. Corporations having to cut prices, partly because commodity prices are higher, but they're not cutting prices, and that's an important factor. And if you take a look at where commodity prices are on a much longer time scale, you can see that we're still well above the crisis of 2009. So if if we're thinking that what's going on in Europe is ultimately going to create a massive recession worldwide, and therefore leading to massive deflation, speculators haven't reflected that in commodity prices, right? Not like they did here, where they quickly assumed that we are coming to the end of the world as we knew it. Right? That still has not been reflected in here in terms of commodity prices. So, again, the notion here is what people are doing with their money in terms of versus what they're saying. They're different. And if you take a look at GDP, you're seeing a rise in GDP in the United States, so it's still growing. The U.S. is still growing despite what's going on in Europe. The jobless numbers continue to come down in the United States. And if you remember from the past, that disparity, that 9% unemployment rate is not evenly distributed. I just looked at it again. The unemployment rate at the people college educated, more than 100,000 a year, are still well below 4%, or I shouldn't say it's at or below 4%. So unemployment at where the money is being spent is not that low. You can see that reflected in personal income, and spending continues to rise in the United States. And you can see here ultimately the end result of all that is retail sales. In the United States, $4.7 trillion by the end of the year is a new record of spending that's going on in the U.S. And month by month, it continues to be tracked. So the point I'm trying to make is even though everyone's very gloomy, what the underlying fundamentals of the economy is still supported. But the reason you need to know this is when you see dislocation starting to take place in the stock market, when you see panic selling, know that in the background there's strength, that ultimately you should take advantage of that downward move, that panic sell, to get involved in stocks. Now, I'll just skip over this. So let me just take a look here in the third quarter. This is actual reported operating earnings from the third quarter. You can see every sector is up from 2 years ago. 2009, 2011 continues to have increased earnings. In fact, in many cases, record earnings for every sector. The one sector I would warn you of is the financials. be careful here, because even though you're seeing this increase in terms of their operating earnings, there's an accounting element to it that is not real operating earnings. They're actually, what you're seeing in the financial sector is continuing declines in terms of their earnings when you back up the accounting gimmicks that are going on. So, but the point I'm trying to make is, other than financials, we're not seeing the impact in terms of corporate earnings from what's going on in Europe, nor necessarily from the slowdown in China. One area, if you recall, commodity prices are coming down. So now, if you're looking at fourth quarter projected earnings, this is the analyst bottoms-up analysis of underlying S&P 500 companies. The only sector that actually is reflecting a decrease in terms of operating earnings quarter-on-quarter, year-on-year, I should say, is in the material sector. And we should expect that if you're seeing. So I'd be careful in the material sector as we go forward here, as commodity prices continue to decline, the slowdown continues in China, and of course the potential slowdown from Europe. But if you think about it, a lower commodity prices was bad for material, could be very good for industrial. We saw oil is very strong and continues to be supportive of energy, and consumer staples could be benefited by reduced commodity prices, because the input costs for both industrial companies and the consumer staple companies, which is food, et cetera, those kind of things, are coming down. They have the opportunity, in fact, to increase their margins in this process. So if you want to find opportunities, these are some of the sectors to look into. So putting it all together, from an operating earnings point of view, 2011 is going to be a record year for U.S. corporate earnings. You wouldn't know that from listening to everybody, but it's a record year in terms of corporate earnings. 2012 continues to be projected to be another record year. Yes, everyone will tell you, well, yes, but those earnings could come in. But you know what, we've been hearing that for 2 years, 3 years. I mean, no one's ever believed the earnings growth that's going on in the U.S. corporations is always supposed to be temporary. It continues to grow. And until I see differently, I'm going to accept the fact that this is going to continue to happen. Now, this is important because what it's creating is an opportunity. This is sales, which will continue to grow too, and margins, which these are operating margins, are back to historical peaks. The point I want to make is really this slide. Here's the earnings, and this is representative of the stock price in the form of the P ratio. Okay, what we're doing is we're compressing the value, we're compressing P ratios, which means the stock market has not reflected all the good news, so to speak, that's going on in the economy and in corporate earnings yet. It's just not reflected there, because everyone is so gloomy and worried about the future. Okay, the facts are that we're progressing nicely. And this level of 11.5, which is where we will be if the S&P 500 closes at where we were on November, whenever this was, November 11th, I believe. 11.5, that would be going back to 1981, I believe, was the last time we had an opportunity to put money to work in the U.S. market, those kind of price multiples. Okay, so it's a long time coming. It could keep coming down, and I will say this to you: when you get to single-digit PE ratios in the U.S., if you go back and do the history, it's happened 4 or 5 times. Every time was during a period of severe political stress, concerns, global crisis. It was the inflation years in the 70s was the last time this happened, which led us into 1982. The rebound was terrific, 30-40% upsides going on after that. So what I think of this is, what this represents to me is we're pressing down on a spring. The spring is the earnings of corporations and the continued upside of the U.S. economy. And at some point, whatever that weight is that's holding that spring down, as it gets relieved, it's going to pop. And it's just a matter of identifying what that is. Breaking it down just a little bit more, if you take a look at sectors, you can see that every sector is up, with the exception of financials. Financials is down. Every other sector is up, projected up for 2012 versus 2007, quite a bit. I mean, there's quite a bit of growth. Technology doubled in terms of the earnings that they had in 2007. We all thought 2007 was the best year ever. This is 2012 could be the best year ever, at least with respect to earnings in some of these, for many of these sectors. So I will use this, because you have access to these, potentially have access to these charts. Use these to identify companies within these sectors, or just play the ETFs associated with these sectors when opportunities present themselves. And if you take a look at PE ratios, you can see the compression. Despite all that strength, that growth in earnings, et cetera, massive compression across the board. I mean, technology is 50% cheaper than it was in 2007 in terms of current prices. Breaking that down just a little bit further, just to convince you that where we are in terms of other major economies. So these are all the major economies. These are the index, the same sectors. The U.S., at least up through November 11th, I know it's changed. These numbers have changed. But through November 11th, was up across the board in every sector. Had outperformed just about has outperformed every other country, right? So while all the gloom was going on, and yes, markets are down, much bigger here in Asia, much bigger in Europe, et cetera, much bigger everywhere, the U.S., in fact, continued to have been an opportunity to make investments. A lot of people are missing that. It's worth exploring these areas that are up. And just looking at the fourth quarter, again through November 11th, you can see the upside that took place beginning the fourth quarter of 2011 in a lot of these industries. The U.S. and Latin America led the rest of the world during the fourth quarter up to that point in time. And I think, quite frankly, it's still the case. So that's all I wanted to do in terms of talking about the underlying market. I hope, I don't know if you have any questions on any of this, but it's the same story. There's strengthening in the U.S. market. There's opportunities in the U.S. market. It's just a matter of recognizing that when you see rapid selling of stocks in the U.S., take advantage of that, because ultimately those stock prices have to come back to some level of reality. Now this is the part I think that's going to be most helpful to you, I hope, which is how to look through all this volatility and identify whether, what we should be doing with our stocks. So there's a couple rules that are operating today. They've been operating, quite frankly, since 1997. And it's very important that you know these, because the institutions, the pension plans, hedge funds, et cetera, are using these to really drive their trading decisions. And that's really what's driving stocks. And the three, well, we know the first one, the high correlations across all stocks right now means that everything seems to move in the same direction of the broad market, represented by spiders here for the purpose of this. What you may not know is the 10-year Treasury yield should be moving in the same direction as stocks. So the old adage that rising interest rates are bad for stocks and declining interest rates are good for stocks is absolutely wrong. Right? They need to go in the same direction. When you see that 10-year going down, that means the stock market's going down. Why? Because money's moving out of stocks into bonds. I mean, really that's what's been going on, right? And the inverse. When you see that interest rate rising, it means money's coming out of bonds and into equity. Now, the reason it's, and the VIX is the other aspect. I'm going to show you this in a minute, but the reason this is so important is that it always has preceded the change in direction of stocks. In other words, it's telling you in advance the direction the stocks are going to go. And I'll show you how that works. I'll come back to this in a minute, but this is what I'm talking about in terms of tenure. So you can see here, now I would suggest you put this ticker, the TNX is the ticker, I've used the tickers here. So put it onto your websites or to your trading platforms or wherever your watch list, and start following this very carefully, because it will help you get in front of the direction, the change in direction of the stock. So you can see here, when the stock prices of the S&P 500 is going up, and remember we said most stocks will follow the direction of the stock market. It doesn't matter what you own. When the S&P 500 is going up, but the 10-year yield represented by the TNX is going down, you have a divergence, right? Because they should be going in the same direction. And you can see this 10-year going down started well before we peaked in terms of the stock market. So if you saw this, and you saw this divergence, you knew that this was a time to start selling, not buying. And then they both started going in the same direction. You saw here they started to rise, stocks started to rise, the stocks kept going, bonds went down. Again, foretold, told you in advance that that rise in the stock market was not sustainable. They cannot exist in opposite directions. Not literally since 1997. Right? And I think that's because of the rise of hedge funds, the dominance of program trading. These are the reasons these things are happening. Came down, you had another divergence here, this continued to go down, stocks kept going up. If you're buying through all this volatility, and that's the point I'm trying to show you, is all this volatility means nothing. Just focus on the 10-year. At least with respect to the broad market. Don't get caught up in day-to-day price moves in terms of the stock prices. Focus on the 10-year yield, and it would have told you that all this up and down move was, again, an opportunity to sell, not to buy, right? And in fact, the first time we had an opportunity to buy was October 4th, and that's why I think you saw such a powerful rally that took place on that day, if you recall. Because the hedge funds, the institutions saw the same thing happening. They actually started seeing a rise in advance of the stock market rising in terms of the underlying yield, the 10-year yield. Again, why is it rising? Because money's leaving bonds and moving in equity. And as it continues to do that, it ultimately starts attracting more buyers. And first happens on the other side. That's been broken now. So this was doing just fine up until the beginning of the week, November 7th, when stocks continued to go up and the 10-year started to decline. We're now back into a declining scenario. So we are on the downside leg here, right? This is not sustainable to the downside, right? And if you go back, you have to go back now to your technicals to try to understand where you are. And so I've put some charts here. What I'm suggesting to you too is, regardless of all this volatility, you start putting together some moving averages. In my case, you can use a 5 exponential moving average and a 20 exponential moving average, or 5-day exponential versus a 20-day simple. What you're doing is you're creating an oscillator that identifies the trend that you're actually in, regardless of all this movement. Okay, so it identifies the trend regardless of what you're doing. Did we, Ryan? Is Ryan here? Battery died. Any questions before we change back? Do you understand what I'm trying to help you with in terms of these indicators? These are not something that anyone's going to tell you about, but I'm just sharing with you that these are very important technical indicators. The 10-year, the direction of the 10-year versus the stock market, very important to big money, right? And that's ultimately going to help you if you use the same techniques that they're using. And where's the you'll do that for me? Okay, so if you just pick them, I mean, I'm using this one in a particular case, but the point I'm trying to make, you see the crossover of the 5 moving average from the 20? Don't use just the moving average and where your stock price is. Ignore your stock prices. Don't worry about stock prices. Focus on these crossovers. This is a simple oscillator. It's very important because it's identifying trends. Stock prices confuse the hell out of you. Confuse the hell out of me. They confuse a lot of people, right? But these are end-of-day moves, by the way, what's happening by the end of the day. Don't use this for day trading. Okay, you'll get chopped to pieces. But this is designed to look at trends over time. Okay? So when I got that 5 EMA crossing above that was the point to buy. Right? Not here, not here, not here, but when this happened. Right here in this particular case, I'm using, I believe, yes, I'm using a 5, which is the blue line, 5 EMA, and a 20 SMA, which is this line. So here was the time to buy. Because at this point, you had a sustainable trend. That's what this is showing you. Up until now, this is volatility. Pure volatility. It hurts you if you go in too soon. Right? But once that broke, that was the time to buy. Let it ride itself up. You're going to get a lot of movement here when you're using 2 exponential and a simple. And then you got the breakdown of the recent curve. But if you're using 2 exponential moving averages, you would have seen that happen much sooner. Okay, that's the time to sell. And that's the idea. You're focusing on these trends. You're not worried about all these candlesticks. Right? And that's going to help you. Any questions on this? All right, so I'm trying to help give you techniques to ignore stock price volatility and focus on something that's much more readable, much more useful in terms of whether I should be buying or selling for my clients. Okay, why don't we move to the, let me go back one first before we do that. The other direction. Yeah, right there. Okay, so the other thing I wanted to point out to you here is this. The stock market is caught, it cannot break through this 200-day line. Okay, this is the 200-day simple moving average. This is your resistance point for the market right now. It's been that way. And you can see how it tries to break through. There's a lot of sellers that will not allow this to go through at this point because they're trying to create a trade range for themselves. Because the hedge funds is how they make their money. They want volatility. Right? They want the market going up and down. And so they've created these ranges. I'm giving you ways of identifying those ranges so you can take advantage of it, but that's the resistance. It needs to break that resistance before we continue to have a sustained root move above. But that, from your point of view, know that when you're at resistance, sell. Support is at 1205. Okay, we're right there. I'm going to bet, I'll make a little bet, that this morning, Friday, which normally the market should be going down, you'll probably see futures open up a little bit, right? Because you're going to see people looking at the support level and want to control it around 1205. If we break 1205, we've got more downside, bigger downside to go from there. But you're going to see some buying take place here. The reason I point out this 1205 is, if you go to the next page, is it's also, ironically, long-term support. 1206. If I go back all the way to 1996, and I draw this line, and I do the Fibonacci. Right? How many of you guys know Fibonacci? Probably, right? If I do a Fibonacci from the bottom of 96 to the peaks up here, guess where I have my 60, what is it, 61.8% Fibonacci is at 1206. So when you have two indicators of the 50-day moving average, right, and Fibonacci at the same point, that is usually very strong support. Right now, it could break through it. Doesn't mean it's guaranteed. It's very strong support because you've got a lot of algo models that are driving off of those things. Okay, so just recognize that today is going to be very important. When we break through, if we do break through, we got to hold 1095 on a long-term basis. That's critical. We've done that. You can see how we've held on the last move down, bounced right off of that line. Okay, very important. So I've covered this already, right? I've shown you how you can use the 10-year yield, not the 10-year bond price, the 10-year yield, TNX, as a divergence indicator that will be predictive of the direction of the stock market. Now, the other reason you need to know this is the bond market is very difficult to manipulate. You may think the Fed is actively engaged. I will tell you, the Fed's out there claiming that they're buying big long-term dated bonds as part of some QE 2.5 or whatever they want to call it. They're buying $2 billion a week. I mean, they're doing nothing. They're letting the stock market, they're letting the market really act on its own. If you realize, as Bernanke knows, there's little left you can do. The problems in the stock market are not liquidity. It's created massive liquidity. The problems of the stock market are confidence of individuals. Right? He can't do much about that. So he is not manipulating this market. This is the movement of money in and out of equities and in and out of bonds, which is very important. Right? Go to the other thing simple thing that I want you to look at is VIX. Now, most of you know what VIX is. It's driven by the option market. The reason it's important to use VIX is the option market remains the domain of big money, right? Sophisticated money, whatever they want to call themselves, right? And often they will position and do what they need to do in advance of doing anything in the stock market because they can get a leveraged return one way or the other, right? The VIX has to go in opposite direction of equities. So this is good. When you see the stock market going up and the VIX declining, that means that you have a sustainable rally. The lower it goes, the better it is. That's, again, a lot of people have been taught the other way. You've been around a long time. You were taught that a high VIX means you're overbought. Overbought, so it's ready to sell. A low VIX, sorry, the other way around. But the point here is they should go in opposite direction. When they're going in the same direction, you have a divergence. Okay, so when you saw this happening, VIX rising and the stock market rising, that should not be happening. Okay, that warned you in advance that you're going to get a reversal. So you should take advantage of that time frame to start selling stock. Why? Why is this happening in advance? Because the big money is in the option market, buying puts, buying protection, getting ready to stop buying. That's what they're literally doing. They're getting ready to stop buying their stock, supporting the stocks. And so it's going to happen first in the option market before you're going to see it in the equity market. It's the way it is. Okay? So you can use that. And the other thing I would say to you is that the VIX must be below 30 for it ever to have hope for the stock market to keep rising. Okay, the lower the better. And when you see the single-digit VIX, I love that because that gives me a huge amount of confidence that I can own stocks. Right? So the lower it goes, the better. 30 seems to be the demarcation point. You can see that right here. We got above 30. We started going below 30. Oh, let's do it this way. We're above 30, the market's collapsing. We get below 30, the market continues to rise. We start getting back above 30, the market's already on a downtrend. So 30 is an important line in the sand. I don't want to own stock when I see the VIX above 30. I'm not going to say that it's oversold, and therefore I'm going to start buying and all the other fancy things. It's a very simple thing. When it's above it, it's not going to work. And if you have divergence, use that to start positioning out of your stock position. Any questions on that? You see how this can be helpful? I don't know if any of you use these things. I don't. I would imagine not in terms of these types of ways of looking through volatility. You guys now know have a technique you should use. I don't know if this works in your markets. I don't know. I just know it from the U.S. point of view. Okay, next page. The other thing is people want to use gold. They want to use gold as a hedge. Gold is not a hedge. Gold is its own asset. It operates completely random vis-a-vis the stock market, at least from the U.S. stock market point of view. Gold could be up, stocks could be up, gold could be down, stocks could be up. There's no relationship between stock prices and gold. And that's important. I just want to point that out. So it's good to have gold, but you have to look at gold on its own. Don't buy gold because the stock market is going down. It's not going to give you a hedge, per se. Right? You buy gold because of has its own characteristics. The dollar does have an inverse relationship to the stock market. So this is a correlation table you can use as you see fit. But I just wanted to point that out. So if you just go to the next slide and you take a look at gold using the current charts, the same techniques, you can see that we have yesterday, I guess, almost broken through that 5 and 20. Right? In other words, we're almost in a downtrend. We're not quite there. We're still positive. We have support here on the 50-day line. So forth. If you go exponential to exponential, we have broken down. So we're in a downtrend on an exponential basis. We haven't broken through on a simple moving average basis. Gold is going to do its own thing, and guess what? The stock market is going down. That's my point. I mean, there's no relationship between the two. They'll do their own thing. And what this is just comparing gold to the S&P 500. You can see how gold has outperformed the S&P 500. Started to underperform the S&P 500, believe it or not. In other words, it performed worse than the S&P 500 when the stock market was declining. Right? And then recently it started to outperform the S&P 500. So you'll have these charts if you want to use them, if you are trading gold. This is just the dollar. You can see the dollar. In fact, you should own the dollar. UUPs is simple if you want to do it with an ETF. You probably may have other ways of buying dollar. Right now, the dollar is an uptrend. So when the stock market's not working for you, put your clients in something that is working. And one of the things that's working is the dollar. Or if you're allowed to go short the market, you can do it through the ETFs that you buy that are actually short. So you always keep your clients invested. Just having these simple techniques, ignoring all this candlesticks. Okay, yield is the best diversifier. As Ryan said, I just want to introduce some of these things to you because we never see any orders coming out of Asia for these instruments, and you should potentially be thinking about them. We talked about the UUP being the dollar. The TLT you guys are going to like because it can move to $3 a day. It can move, right, and it can continue. So TLT is the ETF that holds 20-plus year Treasury bonds. Pays a decent interest rate if you happen to be holding it over the interest rate period, so you can actually pick up some money. But 78%, you can see how the correlation has gone much deeper inversely versus the stock market over the years. So you could actually, when the stock market's declining, you can put this on, or you could put this on as a true hedge against a stock position that you own. Right? And these are just different assets. This is the TLT, which is government. This is investment grade corporates, meaning couple two are better. This is mortgage-backed, which is usually investment grade. Right, so this is an interesting new instrument for you to start considering getting your clients into when you're seeing a lot of downward movement or volatility, or you're seeing those crossovers going against you in terms of the equity market. Maybe you move your client into a TLT position. And the reason you're going to want to do that is the next slide. I hope. Yeah. If you did that just before, remember, you saw it advance through the VIX, and you saw it advance the TLT through the TNX, that the stock market was going to roll over, right? If you use those as indications because you saw divergence. If you put your client into TLT, you'd be up 25% for that client in this very short period of time. But most people don't even look at the TLT because they just want to get caught up in looking at stocks. So just add a different asset class that is inversely correlated to the stock market, you have another tool to go make money for yourself and the client. So the TOT is up, and you know, it's continuing to go up here now as the stock market continues to decline. Investment grade does not. This has a little bit of its own issues because there's a credit concern here. This presumably has no credit risk. This does have credit risk, but the point here is even if you want to go with investment grades, because it does have a higher yield, it tends to operate positively. And this is the stock market. It's been, what was going on. This is up through the 7th, so we haven't cut this. Any questions on this? So, using bonds through an ETF. You don't have to get worried about buying individual bonds, just use the ETF to do it. And you can trade it in and out like anything else. It trades millions of shares a day. There's plenty of liquidity in the TLT because all the hedge funds and mutual and pension plans and institutional investors are using it to do exactly what I'm telling you. I'm suggesting you guys do. Okay, and so here's the TLT in an uptrend, broken up to the upside here, breaking up to the upside in terms of this moving average, well above its 50-day, well above its 200-day, breaking upwards in terms of outperforming the S&P 500 here as the S&P 500 collapses. So this is a very nice instrument to be involved in right now, not as a trade. That's what you guys, because you don't want to hold this in a portfolio. This is a trade that you're going to want to do. And you're going to want to do it until you see these things cross against you. And this is just a list of other tickers that you may want to think about. This is the yield that it pays right now. So this is a high yield. But all these trade on the stock market as ETFs. The nice part is if you happen to own that over a record date, you get the entire dividend. There's no accruing of interest like exists if you actually own the bonds. It pays just like a dividend. You own it on the record date, you get the entire month of interest. You don't own it on the record date, you get no interest paid to you. But they pay every month. And that's just a little bit of a bonus that goes into your client's account. Before we go there, any other questions on that? Because that's pretty much all I really wanted to cover with you guys. Giving you those little techniques to not get caught up in the candlestick and all the volatility that's going on here. Just have a different way of approaching the market that can help you and help your client. Are there any questions? Yeah.
I was wondering, you talk about this credit risk for ETF. There's no credit risk.
You mean in terms of the ETF having a credit risk associated with it?
Yeah.
I mean, because they use futures and other things. When you're dealing with the TLT, I wouldn't be concerned by that because the underlying instrument is the government bonds, which are multi-trillion-dollar industry. I mean, there's you're not dealing with esoteric products.
What I mean, credit risk in the sense of credit risk in the sense that all these cross defaults and would they possibly be a breakdown and
yeah, I've been asked that a few times, and my question came back. The way I look at it is we had that opportunity, didn't we, in 2009? I mean, why didn't we see it blow up then? And because that was pretty severe. I mean, that was a credit crunch like we haven't seen in our lifetime, to be honest with you, any of our lifetime, right? So we didn't see that happen, and the reason is that I think it's over-exaggerated quite a bit. I used to do structured products when for Morgan Stanley, and I know how these things get created. And while the notional amounts are massive, trillions and trillions of dollars, we never did anything that we couldn't. Basically, they're structured just to pay the performance. They're like a CFD. Many derivatives are like CFDs. You're not putting up $1 trillion. You're only selling movement changes in the price between the strike price and the current price, right? And second, we always hedged it. And we used to hedge it in the liquid markets, but it wasn't we went and got another credit risk on the other side. So I think that's the reason you didn't see the blow up when we should have had the blow up, is because I think they're managing them better. And quite frankly, I think they're managing them better now than they had before. AIG was a different story. They were doing what you were suggesting. They were just taking credit risk all over the place, and they had to get bailed out.
I suspect that one of the reasons why people here they're not so familiar in the education part. It's a bit of a problem.
Yeah. I mean, I'm with you in the sense I wouldn't buy necessarily ETFs that depend on futures, but unless the future contract that it's part of is massively traded, and that's the case here with the TLT. I'm sorry, you had a question.
With regard to U.S. bonds or?
Yeah, it's U.S. government treasury bonds. Sorry? just U.S. government treasury bonds with that's the TLT itself, of 20 years or more. Okay, now, there are other ones you can do, I forget the symbol, TVF, I forget the symbols, you can look them up. There's a ETF for 10-year treasury bond yields, right, treasury bonds, 3 month. I mean, you can have all different maturities. There's an ETF for every one of them. I just picked the TLT because I have one.
Well, this operation twist that they're having with the Fed, do they have an impact on this field?
It should help. It should actually improve, because if they were truly doing Operation Twist and buying a lot of long-dated bonds, what's going to happen? Bonds go up, right? They're going to go up in value, right? Well, I shouldn't.
The yields will come down.
The yields will come down, which means bond prices go up. So from a capital gains point of view, you're actually getting the benefit of the government buying. So I know though factually, because I look at it every week, they're doing very little actual buying. They're buying $2 billion in a multi-trillion-dollar week. They're doing very little. But the point is, you do have the backstop of Bernanke saying, "I want your bond," and that's only going to help you get capital gains. Don't rely on that though, because at the end of the day, he does not want to manipulate the stock market. He's letting the market do its thing. Right? He did Operation Twist because he had to do something, but it's not. He realized it's not going to make a big difference. What's going on?
Can you explain a little more on this knock-on effect on Europe crisis onto America? Just now you were saying that they don't see the knock-on effect won't be so huge unless this part of the world, right now.
Yeah, what happens here in Latin America? Yeah, I'm not saying that that's not going to have a knock-on effect on stock prices. Okay, they will. People are we're emotional creatures, right? So we get nervous, we panic, we sell. Right, so what I'm saying is when you see that happening, you should know that underneath there's strength enough that you should be willing to buy, because it's a mispricing. It's already mispriced. 11.5 PE ratio is already mispriced. If you get opportunities to buy it even cheaper, take advantage of it. Now, so you're absolutely right. How the rest of the world reacts to what's going on in Europe is a more important driver for U.S. economic growth and corporate earnings than Europe itself. Europe, as I said, is a small piece of what we're actually doing these days. U.S. stopped looking at Europe decades ago. U.S. corporations stopped looking at Europe decades ago as the future, as their growth path. And they shifted to Latin America and to Asia, which is where growth actually is. That's why it's become less important to U.S. corporate earnings. But if you guys slow down and you stop buying U.S. goods, yeah, that's going to have an impact on U.S. profits, and therefore the underlying premise of cheap stock prices goes away.
What is the impact of any of these European countries defaulting?
Again, I think it's all emotional. It's all emotional because at the end of the day, capital markets are already reflecting the sovereign rating of each country individually, which the euro was formed in 1999, right? From that point on, the capital markets assumed it was one big credit risk. What we're learning is there is no mechanism to have one big credit risk. Every country never really joined the euro. I mean, that's really you have to think of it. No one ever joined the euro. There is no euro in the context of the credit markets anymore. Every country stands on its own. If you go back to 1999, interest rates in Italy were well over 7%. Every market had higher interest rates than where they went to. Right? So the capital markets are readjusting to the reality that the countries stand on their own. And worse, they're handicapped by the fact that they can't print the real money. Right now. So default, I'm not that worried about because as I showed you, at least with respect to U.S. corporations, we're not seeing that impacting dollar funding. It's going to impact the hell out of European funding. But it's not going to impact dollar funding because Bernanke already has put huge amounts of dollars into the marketplace. So we're not going to see that. We will see it in the financial sector. I will tell you, continue to tell you, now is not the time to be involved in this U.S. stock, U.S. banks. There's no reason to do it. It will impact that. Right, but it's not going to impact GE, it's not going to impact industrials, none of those industries are going to be impacted at this stage. And the other thing you have to bear in mind, and this is a very important distinction, the problem we had in 2009 was the banks buying privately created debt, mortgages. They created that product. So they deserve to go out of business because they were idiots, right, for what they did. CDOs, all this garbage that they created, right? They deserve to go away. Here, who's the sovereign debt crisis? It's a sovereign debt crisis. So it's the equivalent of Well, you declared bankruptcy because you have 10 billion Singapore dollars in your pocket. I mean, within Singapore, you're going to spend that money. Right? Within France, you're going to spend the euros. When you get outside, the problem is going to be local. It's going to be for the Europeans. Because if they want to export or import, they're going to have a problem if that euro ever gets devalued. Right? But outside of Europe, it's not a problem. I mean, we're going to be okay. In fact, quite frankly, U.S. corporations are going to take advantage of that. They're in a position to go in and take market share from those European firms. So net, this could turn into a longer term advantage for the stronger countries, which includes Asia, which includes the United States, vis-a-vis Europe, if they don't get their act together. Right? But it's all emotional. And emotions will be the initial reaction, and our job is, get through that emotion, use these little techniques. You have to find opportunities to actually put money to work and make a quick buck for your clients.
Your big and your big charge and your little charge, where does it come from?
Well, you could probably, VIX is a ticker. You should be able to put on index tickers in your chart package. Just, I don't know exactly, but the part package I was using is a $sign BIS. But yours it might be. I would just experiment with it, with your chart packages and see what. But I'm sure it's in there. It's a ticker. Yeah, it's not a something that should be available anyway.
What about contagion?
Sorry?
Contagion?
Yeah, and again, I think contagion is within Europe, right? And the reason I say that is it's a sovereign debt issue. So the problem is people who rely on euro funding, euro currency funding. The U.S. doesn't rely on it. You guys don't rely on it per se. So I'm not expecting contagion the way it's being defined. Contagion in the sense, could we have a recession because we all get so nervous we stop buying over here in Asia, and if you guys stop buying things in Asia, the U.S. then it's contagion in terms of how we act as individuals. We have to be worried about that as humans. But contagion with respect to money, currency crises, or credit crises, I just don't see it. I mean, maybe I'm wrong. I could be wrong, but I just don't see it.
Yes, but we get the European banks.
Yes, I agree. But again, the U.S. banks will step in, other banks are going to step in, and things are going to step in. But I agree with you. But let me ask you that. I agree, but how does that create contagion if the European banks are weak?
For example, if there's some relationship with Asia from lending,
if the Asian banks are lending to the European banks, yes. I mean, again, the whole financial sector worldwide, I agree with you, you have to be careful. But the difference is, if Asia needs to inject money into its banks, it can. The U.S. has to inject money into its banks, it can. Europe needs to inject money in its banks, it cannot. Because the sovereign countries can't print money. They can't print the money. So if Merkel and all those guys don't allow them to create euros or do euro bonds, they're stuck. Because the only place they can raise money to inject to the banks, their own banks, is go to the capital markets. The capital markets say, you want my money? 10% interest, 7% interest. They're stuck. Huh?
Privatize their companies, their government companies, their infrastructure, privatize.
What do you mean? I'm sorry.
If you're not mistaken, historically the Europeans normally use bonds and loan to finance all their projects.
Yes.
The equity. So now they can convert this into equity to raise funds.
Well, that's an alternative at the corporate level, right? You can maybe get equity.
Government does the same thing.
Well, government, what are you going to?
Singapore, we actually privatize our airport.
Yes, you're right. I agree with you. There's way, Europe has the ability to solve the problem. What they lack is the political will for them to become no longer sovereign nations. That's really what we're talking about. You have to act like the United States of America, where every state is a country, right? But you're under one government program in terms of taxation, one government program in terms of debt raising, right? They're culturally, they've never been one country. They've always been sovereign countries. They're going to be forced to do exactly what you just said. You would think they want to, but but they can't, there is no cheap bonds in there. You would think they may want to do that, but they don't have the ability to do it because they have to raise cash. And to raise cash, the Fed can just go to Congress, the U.S. Fed can go to Congress. I know, but they're limited, there's a set amount of money that they've been given. They now have to go back to the 17 members and get permission to do more. So they don't have one place to go. They've got to go to 17 sovereign nations and say, will you allow us to raise money? The U.S., Bernanke went to Congress, got a $2 trillion check, he went out and printed the money. So they have structural problems, big structural problems in Europe that have to be resolved.
Can you comment on the long-term trend of the U.S. dollar?
Well, right now it continues to decline, right? But I think it needs the election process before we know. In other words, if we begin in the U.S. to ultimately clean up the debt that we put out there to solve the 2009 crisis, I think the dollar could start rising again. Right? I think it could, because the reason I say that is because ultimately, if the U.S. is as attractive as I think it is going forward, in other words, I think the U.S. has reasserted itself as the leader, right, in terms of the economy. It hasn't been the leader in probably 20 years. Right? Well, let's say 10 years, right? Because China took that mantle. China was leading the world in terms of growth, right? And the U.S. was not in the same path. If you go back to some of the things I showed you, the U.S. is now reasserting itself in a leadership position, which means it will attract capital from around the world. As capital comes in, the dollar is going to get stronger because people need to buy dollars to invest in the United States. So if we are truly now becoming not today, because I know we look at the U.S. looks at the rest of the world looks at the U.S. in a way that's not positive. I understand that, right? But if we get to where people can get confidence again back in the U.S. as being a leader, an economic leader, it's going to attract capital, and the attraction of capital means the dollar is going to get stronger. We're doing that at the same time as we're reducing the debt, meaning we're reducing the amount of dollars in the marketplace, you're going to see the dollar come back. But I don't expect that to happen until after November 4th of 2012, because you're going to need an election process for the country to decide what it wants ultimately to do. It doesn't want to reassert itself in that way, or does it want to continue to move towards a European way of governing, doing things, which hopefully people are waking up to, realizing that Europe is in fact turning to be false. So that near term continued decline, longer term, hopefully we'll find our way back.
So I mean, what is your opinion from now on the Dows or S&P from now to the election?
Next year?
Yes.
Yeah, if you go back, let me see. Keep going.
Because now the Dows is below 200.
All right, stop. Go back one. Right. See, I don't know the answer to this because I don't know how our emotions are going to play. I don't know what's going to happen in Europe. Things are going to look so ugly. I don't know the answer. But let's say it this way, right? If we can get back to a normal level of valuation, normal P ratios, historical. If you look at this, you see, look here. It's right here, right? I went back 108 years. If I average that out, I use what's called a harmonic mean, so people who are engineers understand that. I'm throwing out the big spikes up, the outliers, right? I'm just focusing on where most of the growth has been concentrated. 14.1. I take $108. And let's assume we're going to ultimately catch up, right? We're going to have, and this is true. We're going to have $108 of earnings at the S&P level. Let's assume it's true. 14 times that is 1535 in terms of the S&P. Now, the question is so the first issue is, do we get back to normal? Or do we continue to compress our PEs? That's going to be the question, right? And that is a function of confidence, both in what's going to happen going forward in the United States. Again, the election process, I think, is a very important thing for the psyche of Americans. It is. So it's going to be very determinant. Now, and the second question is, are these numbers too high? Will they be cut? I will tell you that before this number got posted, 97.5, everyone thought this was too high, right? And they thought this was too high. So it's this wall of worry. We constantly are worried. We're worried. At some point, we have to get to this level. So to answer your question, is that 2012 or is that 2013 or is it 2015? I don't know when. But at some point, earnings hold around here, we should be getting back to these kind of levels. And if earnings continue to grow, this number will continue to rise. Does that make sense? Remember, this number here, this P of 11.5, I kid you not, last time we had this was coming out of, we had 14%, 18% Fed fund rates in the United States, because this was after the 1970s energy crisis, inflation crisis. We had a mess. So this is when Volcker came in and started raising rates up. Because we're sitting here with a P ratio of 11.5. Back then, Fed funds rates were, as I said, something like 14, 15%. 10-year rates, I'm sorry, were like 14, 15%. We're sitting here with 2% interest rates on the 10-year, and we have a P of 11.5. I mean, if you do this from a Fed model, I don't know if you guys are familiar with the Fed model, which you shouldn't be really used, but it's an interesting theory that takes a look at the yields of equity versus market. We should be sitting right now at 3,500 on the S&P. If you just look at how cheap money is versus the earnings of U.S. corporations, 3,500. I'm not even talking. I mentioned it to you just to give you an example of how high stock prices could be if things were in a normal environment. I'm just focusing on something more simple, 1535. Yes.
Recently, Warren Buffett says it's buy big into IBM.
That's right.
Okay, what do you think about the technology sector at this moment
Okay,
compared to the historical P?
Yeah, let's go into that. I think which direction? Go one direction. Keep going. Okay, stop. Keep going. Wrong. Okay. Yeah, we are going. We gotta go the other direction. The other direction. Yes. So we see a table here. Go back up. One more. Okay, so here are the PE ratios, right? These are all P. This is a table of P ratios. Okay, this is what Warren's a value investor. He saw this. He sees what I'm showing you right now. Okay, and so he says, look, here's technology. In 2007, right, when we thought the world was going, was the great, everything was great. 23.72 was the P ratio of the technology sector. Okay? Here we are. Projected earnings for the technology sector in 2012. Technology has more cash on its balance sheet than any other sector. If I did this with cash, if I backed out cash, you'd be seeing a P ratio of single digits, 8. Right? And what I tell you, whenever you get single digits in any sector or in any market, you have huge upside on the other side when it recovers. 50% compression is the value of the technology sector since 2007. Just go back up one more. And if you look at earnings, and the reason for that is, look, here was the greatest point in our history, 2007, at least how everyone thought about it. $17.35 per share for the technology sector. We're at $35.92 projected for 2012. I mean, this is unbelievable valuation. And he saw it, and he bought the best company he thought that he could understand in that sector.
So there's do you have any statistic on the so-called dividend yield and the ROE?
I don't have those statistics set up, but you know exactly where. I mean, look at these things and what's going on in these worlds. You're going to see some unbelievable valuation, and you're going to continue to see the continue to grow. So what I say to you is, when you see a big spike down in the market because everyone's panicked and jumps, buy a little bit, then wait for the next spike, buy a little bit more, because you're buying at valuations that you and I have never seen. I'm a little older than some of you. I've never seen, and my kids are probably going to be the next ones to see it. Or not only to get my kids, my grandkids will be the next people to see these kind of valuations if the world doesn't collapse. I mean, if the world collapses, we don't have to worry about stocks. We have other things to worry about that.
So the other question, I want to ask your opinion. Let's say it's based on your so-called your opinion. Let's say it's an advanced country, especially like US, Europe. Okay, let's say it's the inflation is above 7% or so-called 10%. What do you think about this, the stock market, the PE? Okay, extremely low, it may fall into single digit.
If you're saying
inflation, let's say for example, any particular year, okay, let's say the US inflation, okay, move above 7%.
I would say this to you, I would say that inflation rising at this point would be the best thing we can do worldwide, because inflation is the best way to reduce debt. Because what you're doing is debt stays fixed dollar, but the value of the asset that you finance is going up. So inflation is the fastest way to reduce debt, right? So I think seeing inflation would be wonderful. I think Bernanke, I know Bernanke wants to see inflation. That's why he's pumping so much money in the system. He's hoping for inflation because it's the best way we do. And if Europe has high inflation, 10, 15% inflation, it's going to feel ugly. But from a debt reduction point of view, it's going to be a gift. You can only hope to have high inflation when you have high debts. Right? It's the best, easiest, simplest. You don't have to worry about austerity. You don't have to do any of those things. You just wait for your assets to go up, and you sell them, and you pay off your debt. It doesn't change in terms of value. So I think it's good. Now, separate from all that, separate from the notion of a debt reduction strategy being inflation, rising inflation is very good for stock prices roughly until it gets to be around 6%. And at that point, it's disruptive. Right? When I say inflation, I really refer to it in the form of interest rates. So I clarify my statement. When the 10-year interest rates gets to around 6%, that's when it starts becoming a disruptive element. But again, in the world we're in today of high debt, it would actually be a good thing. But in the normal environment, it becomes disruptive. So from 0 to 6, I go with it. Because remember what I said to you, what did I say earlier? Rising interest rates means rising stock prices. You want the two to go together.
Inflation, if, as you said, if it gets out of hand, you bring instability.
Yes, if it gets out of hand, I'm with you. I agree with you. I'm with you. But when, in a normal environment, you're absolutely right. It can be very, very bad. But when you have a lot of debt, if it gets out of hand, you're right. But imagine if it gets out of hand and the value of your home goes from where it is today to 2 times its value. You can pay off your mortgage and have money in the pocket because debt doesn't change with inflation. It stays the same. Dollar debt's dollar debt. Right? But if the assets go up, you can pay that debt off. That's why it's a good thing. But I agree with you. I agree with you in general terms. How to control inflation is not a good thing.
Well, at the moment, I think you have some problem with your asset because your housing problem is posing a big challenge.
Yeah, in the U.S., the one sector that remains in the doldrums, which is also why financials are in trouble, continue to be in trouble, is the housing sector. Now, and quite frankly, I think is the primary reason why the mood, consumer confidence remains poor, right? Because most people, I can't sell my house if I wanted to, right? So it is bad. But having said that, 2 things to note. One, it is stabilizing. It's starting to stabilize. We're seeing some interesting things. I don't have it here, but I just saw it yesterday. They've started. Housing starts have started to pick up for the first time since 2006.
Has it bottom?
We're bottom. That's my point. We're starting to bottom on the housing side. And the reason is because what I showed you also, which is spending is going up. If you look at the affordability of housing today, given where interest rates are and the fact that personal incomes have come up, particularly at the higher end, right? The housing is more affordable today than it was going back post-Great Depression. I mean, that's how far back it goes. We're again at a generational level of housing affordability. If people want to have the confidence to buy, they don't. And it's just a matter of that confidence. So, but as that confidence finds its way back into the system, either because for whatever reason, whatever can cause that to happen, I think you're going to see that stabilize. And once that's stabilizing, again, it'll help with the confidence of the United States. And I think we're going to start seeing the stock market outperform even more than it has. Remember what I showed you? I showed you every sector in the world against every world market. The U.S. has outperformed every one of those this year. And you would never know that if you're listening to CNBC or listening to the news or listening to general commentators. It's outperformed everybody. And that's telling you something. Something's changing in the U.S. Maybe we're now an emerging market. I always thought we went down the toilet years ago. We're an emerging market again, and maybe we'll re-emerge ourselves in terms of where we want to be as a country. So just keep your eyes out for all this stuff because it helps you get your clients involved when they think is the best time to pay. I have to say though, I have to congratulate you guys because one thing I see a lot of order flow from around the world, right? Clients like yourselves around the world. You guys are very good at buying bottoms. Very good.
Well, the political noise is occurring in the US. Will it have, it has much of an impact because the emotions that
Second,
the
the politics is the primary problem we have. The politics we have in the U.S. right now is so divisive. We've not been this divisive, to be frank, since, I kid you not, since the Civil War as a country, where people are just divisive politically, rhetoric. Literally, you have to go back to the Civil War when the South and the North were deciding whether the United States were going to be the United States. We're literally at that level again, and there's stats that show that. Because the way politics has been conducted in the last 10 years, 20 years in our country, it's been devastating. And so again, this is why I think we need to change. We need to figure out how that's going to work. The electorate, the House, we have to decide that. By the way, just real quick, I just want to show you a couple of things that you'll have in the slides, and then if you go to others. So let me just show you. These are just some stocks that I see quite a bit of activity in. CLWR. I don't know. I mean, I know this company, but I don't have any fundamentals. But if you look at it purely from a technical point of view, this stock looks like it's consolidating very nicely, right? And I don't know why. I'm not giving you a recommendation. I'm just pointing it out technically. So it's consolidated very nicely around the Fibonacci pivot point. It's outperformed. So this looks pretty decent. Go to the next one. MPEL is broken down. Through all the things I've shown you, it's broken down. Next support is around 825 range. So maybe you want to look at it when it gets to around that level, but not before. JP Morgan's broken down again, so there's support around here. So you'll have these charts, but I put together some of these things. Now just click through a couple more. GMCR looks like it wants to try to do something, but it's definitely still negative. SDS, I don't know who's buying the short S&P 500, but congratulations. Because you should be, right now is a good time to be short. You should have some good upside here up to 22.48. LBS looks very good. Okay, again, because LBS has nothing to do with the rest of the world. It has to do with what's going on in the Macau for the most part. So, and here in Singapore. So it's looking decent, technically. And it has resistance here at 68, which is Bank of America, I'm sorry, Boeing. Now you guys aren't looking at Boeing. Boeing is looking very interesting. There's been a lot of news on Boeing recently. Technically, it looks very, very interesting with resistance here around 68. So it's something to think about if you're looking for a stock to be doing some research on to make recommendations. Which you have to do. I did not do that for you. Bank of America doesn't look at this. Bank of America has never been a good trade the whole year. Please keep your clients out of Bank of America. I know sometimes you get tempted by $5 stock prices, but this doesn't have any legs to it right now.
What about Citibank?
Oh, thank you. I knew you were going to Citibank is actually looking decent. I actually got involved in a little bit. I bought it here, around here, sold it here, and it's broken down since then. But I think this one has legs. So if you're looking for a stock that will give you another opportunity, I think Citibank is that one financial that will do that. But wait, let me go back to Citibank. It's broken through everything. So really you have to wait for this. If you're going to use this type of a crossover, you have to wait for this crossover to take place. Because it can continue to go all the way back down to 22s and 23s at this stage. I mean, it's just nothing but downside from here until you see it reversing. But I think it will reverse and give you this kind of an opportunity there. And ultimately, I believe it will be one of the first banks, JP Morgan potentially too, but one of the first banks that will have upside, sustainable upside over a longer term. Citibank. But you have to time it. So right now, it's still a trade. It's not reinvested. Apple, everyone loves Apple. Apple's in decline. Okay, it's broken. The stock as a stock, it's a great company. It's a great product, but as a stock, it has broken. And you're going to have to wait till it gets closer to the 363, which would be the next step. You see here, that was very strong support, the 200-day line. It did bounce from there. We may get another bounce here again. The problem with Apple is that everything, everyone knows it's about its product, what it has. And without jobs there, I think people are starting to look at it more like a Microsoft. A great stock, I mean a great company, but doesn't have the ability to continue to produce the product and give it the growth where it deserves to be the second largest corporation in the world. leadership may be missing. So, of course, the corporation. The only thing I think that Apple needs, if Apple ever found its way into corporate America and corporate world, if its products were being sold now to corporations as opposed to just consumers, that may give it some legs. But I think even that might be short-lived in terms of the upside. Right? But the reason I say this, if you look at analysts, everyone says this is a $500 stock. Well, the reality is people aren't looking at that. So look at it when it gets around 363 as a potential trade buy. You buy around 363, but with resistance at 395. That's the way you have to look at this thing. Right? It's a tradable instrument. It's a tough investment. MGM, broken. Again, this is primarily domestic. So Las Vegas Sands is a better play. And Boeing, I did this already. Okay, so Boeing has some upside, and Philip Morris is looking really good. But you'd expect that in terms of consumer staple company. Right, that's it. Right, so that's my last slide. Maybe not. Not if you know how to play with it. Right? If you learn how to look through all this volatility and spot the opportunities, the movement of debt on the side of the movement of different instruments, you can stay active in producing money for yourself and your clients, and be on the right side of the curve.
Most of the charts shows really
Vulnerable time. We got to. That's why moving to look at TLT as an opportunity.
Can you see Brooklyn referring to 2016
Say again?
Can you see Brooklyn referring to?
Oh, when I go back up, when I'm saying, I'm looking at it. You can do hundreds of technicals. So everyone will give you that. These are the ones I find from the trending point of view to be very simple to do, right? So when I go back up to MGM, in this particular case, the 5-day exponential moving average is crossed below the 20-day simple moving average. When I see that happening, and I see it happening after a couple of days, to me the trend is broken. You're in a negative trend. The green line here is the 50-day, right? And we've fallen below that, which is another technical negative, right? And the 200 days all the way up here. So MGM is just, you had a nice run here, but the buy point would have been here, the sell point should have been there. And now you got to wait for this thing to reverse back up. Until it reverses, don't worry about the candlesticks. Don't worry about the day-to-day price movement, because you'll just get chopped to pieces by volatility. I use this just to clarify myself. Clarify.
So you use 20, 50, and not 5, 50.
Say again?
Do you see the 20 and 50?
Well, you could use that. Up here, I'm using two exponential moving averages, the 5 and 20 exponential. This will give you a faster turn. So while here I told you to sell, waited here to sell, here you would have sold it earlier, right? But sometimes these you have to decide. I use a couple of them, and I just get a feel for it. After a while, you get a feel for it. Think of it. When I look at these things, these lines, I think of money moving. I don't think of stock. I don't think about MGM. I don't think about the stock price. I just think, where's money? How's money flowing? And just imagine a notion of money. Right now, the money's coming out of this particular stock.
How about cutting the first 200? This one will hold the more long. 50, 40,
that cross that they talk about. Yeah, those are important, but those are longer term. Those are longer term trends, and they're important. But we live in the world of trading, and so the shorter ones are a little bit better. But when you see all those things cross in the wrong direction, I think that could be negative. And
one last question.
Sure.
The super committee that is meeting this coming Wednesday, any negative reaction?
Yeah, of course. It's going to scare the hell out of the market.
You did?
Sure. Because if they don't come up with $4 billion, I guarantee you, we'll have another rating cut on this Treasury, U.S. debt.
Would they want that to happen? They will try to do something.
They can't. They're politicians. Come on. I mean, they should. You know what? They should, and I hope they do. And if they do, they surprise the market will get its pop. They'll get an upside move. They'll get the confidence they need. That's part of what we're looking for.
Whatever they're trying to do is trying to jeopardize Bernanke's chances of making it
Obama.
Yeah,
Obama's chances of being
Yeah.
elected.
Elected, so.
That's what the newspapers say. The newspapers are supportive of Obama. No, they have been that, they are, I don't know what they're doing. I really don't. I mean, but we can't, we have to go with what they do. More importantly, focus on what the corporation, remember, the market's done extremely well despite Washington DC. Right, and that's why I don't try to get too caught up in what they're trying to do. I'm expecting another rating cut on U.S. debt. I don't think it matters. Because if we're all single A, or we're all triple B, or we're all C's, who cares? I mean, it's all relative. At the end of the day, it's all relative, right? So if the whole world is a C someday, the whole world's a C. I mean, the C plus is better. It's not going to impact how companies make money. The rating of bonds.
Do you see any chance of Nike coming up with any stimulus packages?
He can't. He's already told us he can't do it. He's told us that he can't. He could come up with all kinds of stimulus, but we don't need it in the U.S. We have plenty of liquidity. The problems are for the politicians to solve, not for him to solve. He's already told us that. That's why when he came up with this notion of a twist, and I'm telling you, the twist is $2 billion a week of buying long-dated bonds. I mean, that's nothing. That, he just came up with it so he had something to say, but there's not much he can do.
But then the market keeps hoping that he's going to say something.
Of course it does, because we've all been dependent on our mama, our mother to help us. And the reality is that's the insecurity of the traders. Are looking for something to grasp. You've got to look at the underlying.
You think that liquidity.
There's plenty of liquidity. There's no reason to worry about liquidity in the U.S. at this stage. And quite frankly, if there was, he'd deal with it. He has the ability to just go put things back to warrant consistent. I'm not worried about liquidity. And the fact that traders and investors are looking for him to create more liquidity, I think is foolish.
So there will be ViewTrade.
No, there's no need. There's literally no need. Now, he may do it anyway because he wants to give confidence maybe to Europe. I don't know, but within the United States, there's zero. It will have zero impact in terms of putting more money into the system. Zero. More than necessary. Huh?
Will they create more confidence for the Europeans?
We don't know what the Europeans. I mean, who know? I don't know. We don't know. I don't know. My point is, the Europeans have always been. You go back. I like to do historical things, and I go back and I look at consumer confidence in Europe, and I look at business confidence in Europe going back 20, 30 years. It's always been negative. They've always been down on themselves and depressed. I mean, it's just the way they've always been. But that hasn't hurt us in the past. I mean, why should it hurt us? That's the way I look at it. What's going to change going forward? I mean, they've never been able to get their act together in a big way. As politicians, right? As a governing body. So how you guys react is going to be the most important. So you guys stay positive. Right, because that's the key in terms of what's going to happen in the U.S. stock market. What goes on here in your side of the world.
Okay, thank you.
Thank you.